I think the path of inflation is the most interesting one. I think certainly from a headline inflation we will get lower numbers because of a massive base effect. What we look really intensively is at the core inflation, and I think the Bank of England said yesterday as well that will stay higher. So they went to 2025 where inflation is really coming down. That is important from our point of view. So higher core inflation, but coming down on the headline inflation means for me, don't expect central banks to cut so early. So we don't, for example, think that the Fed is cutting 3 times until next January. So it's rather stay.
Cutting. Hang on. We're not done raising rates yet, are we, in the UK?
In the UK, I don't think so. I don't think so for the ECB as well. I think for the Fed, probably yes.
What's the terminal rate then at this point for the UK, do you think? 2 more 25 basis points?
I would say 1 more.
1 more.
And for the ECB, 2 more.
And then we wait.
That's what I would think, right? Because why, if they cut right now, they would really forecast a recession. By the way, markets have not priced this on the equity side, at least. And from that perspective, I think it would be prudent, if I may say, for a central bank, just wait how the data is coming in. I think the worst impact would be you see inflation coming down, you cut, and then you have to admit, oh, sorry, it's very sticky on the core side, we have to go up again. I think that flip-flop would not be so nice, to be very honest.
Christian, the lovely thing about this is I haven't looked at what your view was on the S&P from last year, so I can say this question with complete naivete. There's a lot of geniuses out there who told us that with the recession we were going to fall to 3,000, 3,200, 3,300 in the S&P. They're at the moment stunningly wrong. Now I say at the moment, with the S&P sitting at 4130. Are they all about going to change their mind now if we skirt recession, or actually do we still think we're going down to those lower levels?
Well, I think, first of all, the market is quite bearish, to be very honest. I don't see many people that are ultra bullish at this point in time, which I think is positive for the market, because if there would be euphoria, there would be more downside potential from our point of view. Our view is that probably if in, say, 1 year's time we are at the same level, and that's quite bearish actually, that's probably not too bad. Because look what has driven the S&P. Some 7 to 8 stocks have really driven the S&P, to be very honest. The whole index otherwise is behaving a bit different, but it's the index, so full stop. So what I'm saying is there would be probably a discussion about lower growth, and maybe there is a recession, which from my point of view is not priced. But then if you look 1 year's time, I think if there's a recession, if at all, it's not a long one. Super strong labor markets, for example. Service looks very strong in the US and in other areas as well. So from that perspective, maybe a bit dip, but then also coming back.
So you sound relatively constructive. Are you happy enough with the valuations you're being asked to pay for, well, global equities, and then obviously you want to dig into some detail on that?
I think valuations are quite high, so you have to pay, right, from our point of view, given where we are in terms of growth and in terms of inflation. And as I said, the market is probably not pricing really what you see on earnings. So European earnings, for example, they have all come down, better than expected though, but so for the full year you don't see a risen to the downside. So something has to go from our point of view. So we rather bid as the market, so it's not against the market, a bit more cautious, also what's coming up in the next week's debt ceiling and so on.